Look, overall, part of the intent here is to bring local lenders, and by local lenders, I mean local banks, back into mortgage lending. You know, we saw such a tight regulatory environment that not only did you see the big national banks really pull back from mortgage lending, and you can't really blame them with the amount of money that was, levied upon these companies through the DOJ and just all these lawsuits and from HUD and, just everything. Wells Fargo and banks like that paid so much money in fines. They just finally said, look, we're just not even going to be involved in government lending at all, or very, very little. And that's what they did. And the benefactor of that was the independent mortgage banking companies, and brokers and the like. Independent mortgage banks, I think, currently have 65 to 80% of mortgage lending, and that was a lot in part to the banks backing out. And so this idea is to bring banks, and specifically local banks, regional banks, back into mortgage lending. So it'll be interesting to see how that plays out. And then, the intended outcome of this: increase availability of mortgage credit. Obviously, that helps bring down costs, potential reduction of mortgage borrowing costs as a result of competition, and more participation from community banks and smaller lenders. Now, I wanted to talk specifically about, what is the impact to independent mortgage banks? Because I work at one, and they do dominate the majority of the space right now. And the possible increase in competition, I think competition is a good thing. We want more competition in the marketplace. That's what, free markets are based on. And that could help bring down interest rates. I think the easing of QM rules and TRID could definitely benefit IMBs, mainly because they're very quick to adopt these new changes. And so there could be a competitive advantage initially because the independent mortgage companies will tend to move quickly. I will tell you that, as much as this is a lot geared towards helping regional and local banks, those are probably the least to act. I mean, they'll be the last to act. They want to see that everything truly is in place before they make any changes. And look, the reality is, if you've ramped down your mortgage operation, it's not just like the flip of a switch to ramp it back up. I mean, there is significant cost required to build out a mortgage infrastructure, not just for the local banks, but for the big banks as well. I mean, they have basically scaled their operations down to next to nothing. It takes not just time, but also the desire and a long-term strategy to grow back up your mortgage operation, where the independent mortgage banks would move pretty quickly on adopting any changes in policy regarding QM and TRID, et cetera, potentially lowering their cost to originate, and picking up more of that market share initially, right? Knowing that there could be challenges down the road with more competition coming back into the market. As I mentioned, possible improvements to warehouse funding costs and access to liquidity that would really help some of the smaller independent mortgage banks. Expanding the credit box, allowing for more flexible loan products. I think we're seeing those products in the non-QM space. It's just, do they become no longer kind of, out of what would be considered a qualified mortgage? And potential growth of the purchase market if housing supply increases. So with these two things working together, if we did see an increase in housing supply, and we see a loosening in credit, obviously could mean good things for the overall mortgage and real estate as an industry.